A single overlooked form could trigger a penalty of up to $10,000, and the vast majority of people with foreign financial accounts have absolutely no idea they're in the crosshairs. If you're living in the United States while you or your family maintains any type of financial account overseas, whether it's savings, investments, retirement funds, or even a simple checking account, the enforcement landscape has shifted dramatically, and it could affect you directly. This isn't a story about wealthy tax evaders shuffling money through offshore havens. This affects everyday immigrants who kept their original bank account for practical reasons. It affects retirees who receive pension payments from their home country. It affects international students whose parents send support through foreign accounts. It affects naturalized citizens who inherited modest investments from relatives abroad. And it affects families who simply maintain a financial connection to their country of origin for emotional security, emergency access, or to help relatives who still live there. The IRS has significantly intensified its enforcement approach and provided clearer guidance on penalties in ways that make even small, completely inactive accounts potential triggers for serious financial consequences if they're not reported according to the rules. The most disturbing aspect of this situation is that countless people who are completely honest, who pay their taxes faithfully, and who genuinely try to follow every rule still end up in violation, simply because they had no idea the reporting requirement even existed. Today, I'm going to walk you through exactly what has changed in the enforcement environment, who falls under these requirements, and what specific steps you can take right now to protect yourself from a penalty that can accumulate quietly in the background until it suddenly becomes a very expensive reality. What makes this update critically important right now is that the IRS has fundamentally changed its approach to foreign account reporting. This is no longer treated as a specialized issue that only affects a narrow slice of ultra-high net worth individuals with complex international financial structures. Instead, enforcement is being applied much more broadly, with clearer expectations, more sophisticated detection methods, and significantly stricter consequences for anyone who falls under the reporting requirements, even if the violation was completely unintentional. This shift in enforcement philosophy matters enormously because millions of people living in the United States still maintain perfectly legitimate financial ties to their home countries for completely normal, understandable reasons. They might have a retirement account they contributed to for years before immigrating. They might have a family-supported savings account that was used during their student years. They might have a joint account that facilitates sending money to support elderly parents or other relatives abroad. They might have inherited an investment account they've never actively managed. In their minds, these accounts feel distant, separate, and completely unrelated to their current U.S. tax life. The idea that simply failing to report these accounts could be classified as noncompliance never even crosses their minds. The underlying reality, however, is that U.S. tax law operates on a principle of global financial visibility. If you are considered a U.S. taxpayer, whether as a citizen, green card holder, or certain categories of long-term residents, the government expects complete transparency about financial accounts you control anywhere outside the United States, regardless of whether those accounts generate any income, regardless of whether you actively use them, and regardless of whether they remain largely untouched for years at a time. This broader, more aggressive enforcement environment is precisely why so many otherwise honest, law-abiding taxpayers are suddenly discovering that something they've completely ignored for years now carries genuine, substantial financial risk. To understand how all of this works in practice, you first need to clearly grasp the fundamental reporting rule that sits at the absolute center of this entire issue: the requirement to file what is commonly known as an FBAR, or Report of Foreign Bank and Financial Accounts, FinCEN Form 114. This is not a traditional tax form that gets filed along with your annual tax return. Instead, it is a completely separate electronic report that must be filed directly with the Financial Crimes Enforcement Network, FinCEN, and it applies if the total combined value of all your foreign financial accounts exceeds $10,000 at any point during the calendar year. The absolutely critical phrase here is, at any point. That means even if the balance only briefly crossed that $10,000 threshold for a single day during the entire year, the reporting requirement is still triggered. You don't T to average the balance over the year, or only count the year-end balance. The requirement is based on the maximum aggregate balance across all accounts. Another extremely common misunderstanding is thinking that each individual account is evaluated separately against the $10,000 threshold. That's not how it works. The rule actually looks at the aggregate combined balance of all qualifying foreign accounts you control. So if you have 3 separate accounts overseas, one with $4,000, another with $3,500, and a third with $3,000, the combined value of $10,500 pushes you over the threshold, even though no single account individually seems significant or reportable. It also makes absolutely no difference what type of account it is. The requirement covers checking accounts, savings accounts, brokerage accounts, mutual funds, foreign retirement accounts, and virtually any other type of financial account held outside the United States. If you have a financial interest in it, or if you have signature authority over it, meaning you can control how the money is used even if it's not technically your money, the law generally expects it to be reported once those threshold requirements are met. Now, alongside the FBAR requirement, there is another completely separate layer of reporting that causes even more confusion and catches many people by surprise. Form 8938, Statement of Specified Foreign Financial Assets, which is filed directly with your annual federal income tax return. While FBAR focuses specifically on foreign financial accounts and is submitted separately to FinCEN, Form 8938 is integrated into your regular tax filing with the IRS and is designed to disclose specified foreign financial assets when they exceed certain threshold amounts. These thresholds vary considerably depending on your filing status and whether you physically live inside or outside the United States, which is precisely why many taxpayers mistakenly assume the form doesn't apply to them. For example, a single person filing individually who lives in the U.S. may need to file Form 8938 if their total specified foreign financial assets exceed $50,000 on the last day of the tax year or $75,000 at any time during the tax year. The thresholds are higher for married couples filing jointly, and they're different again for taxpayers living abroad. The critical point that trips people up constantly is that FBAR and Form 8938 are absolutely not interchangeable. Filing one does not automatically satisfy the requirement for the other. They serve different purposes, go to different agencies, and have different thresholds and asset coverage. Many people unknowingly file their annual tax return without including Form 8938, genuinely believing their reporting obligations are complete, while simultaneously overlooking the separate FBAR filing requirement altogether. This layered, fragmented structure is precisely what creates widespread compliance gaps, not because people are trying to hide anything or evade their obligations, but because the system itself feels unnecessarily complicated and technical, especially if you've never been clearly and explicitly guided through it by someone who understands how the pieces fit together. What has dramatically heightened concern recently is not merely the existence of these reporting forms, but the way the IRS has clarified, reinforced, and begun actively enforcing the substantial penalties tied to noncompliance. For non-willful violations, meaning situations where a person simply didn't know or didn't realize they were required to file, the penalties can still reach up to $10,000 per violation. And here's where it gets truly frightening. Those violations can accumulate across multiple unreported accounts and across multiple tax years. If you failed to report 3 foreign accounts for 2 years, that's potentially 6 violations. For willful violations, cases where the IRS determines that someone intentionally and knowingly avoided reporting requirements, the financial consequences become dramatically, devastatingly more severe, potentially reaching the greater of $100,000 or 50% of the account balance per violation. In extreme cases, willful violations can even carry potential criminal penalties. Even more unsettling for many honest taxpayers is understanding that these rules don't only apply going forward to future tax years. If there were past years where required forms were not filed, those years can still come under scrutiny and potential enforcement action, especially as international financial data sharing mechanisms have expanded dramatically. This means that a reporting oversight from 3, 4, or 5 years ago, something you may have completely forgotten about or never even realized was required, can suddenly resurface as a serious compliance issue today. That realization is exactly what triggers so much anxiety and sleepless nights for people who have always genuinely tried to follow the law, pay their taxes honestly, and do everything correctly. They suddenly recognize that a simple lack of awareness about an obscure reporting requirement could carry financial consequences they never imagined possible. At this point, a question naturally emerges that many people are quietly wondering. How would the IRS even discover an account held in another country, especially if you've never transferred money in or out recently and the account just sits there largely untouched? The answer lies in the sophisticated global financial transparency systems that have developed rapidly over the past decade. Many foreign financial institutions now automatically share detailed account information with U.S. tax authorities under international agreements, specifically designed to combat tax evasion and increase reporting accuracy and compliance. The most significant of these is FATCA, the Foreign Account Tax Compliance Act, which requires foreign financial institutions to report accounts held by U.S. taxpayers directly to the IRS. This means that even if you personally never mention an overseas account anywhere on your tax return, even if you never write it down or disclose it in any way, the existence of that account may still be completely visible to U.S. authorities through these automatic data exchange channels. You don't have to move large amounts of money internationally. You don't have to actively trade or generate investment income. Sometimes the mere fact that the account exists under your name, or that you have signature authority over it, is enough for it to appear in cross-border reporting systems that feed information directly to the IRS. This doesn't necessarily mean the IRS is actively targeting honest taxpayers or that enforcement agents are combing through every foreign account looking for violations. But it absolutely does mean that the old assumption, "Nobody will ever notice this account because I never use it," is no longer a safe or realistic assumption. The technological and regulatory infrastructure has evolved in ways that quietly but dramatically increase visibility of foreign financial accounts, which is exactly why proactive awareness and voluntary compliance are now far more important than they were even 5 or 10 years ago. The first practical step is conducting an honest, thorough inventory to determine whether any foreign financial accounts you are connected to ever crossed the relevant reporting thresholds during the year, even briefly. This means looking not only at accounts you actively use and think about regularly, but also at older accounts you may have forgotten, joint family accounts where you have signature authority, inherited investments you don't actively manage, foreign retirement or pension funds, or any account where your name appears and you can control or access the funds. I break down complex tax compliance, immigration regulations, and financial reporting requirements, so you can stay informed, fully protected, and completely compliant with U.S. laws without feeling overwhelmed or intimidated by technical jargon. If you've worked hard to build your life in the United States, if you've followed the rules, paid your taxes honestly, and tried your best to do everything correctly, the last thing you deserve is to face unexpected penalties over an account you barely even think about anymore. Remember, awareness, organization, and proactive action together form your most reliable protection. By understanding these requirements clearly and taking appropriate steps now, you can move forward with confidence rather than worry.